We will get started in 2 minutes. We're going to give folks a few minutes to join, but if you can hear us, please let us know where you're joining from. We'll get started. I'm joining from New York, which is getting warm. Not quite as warm as, well, hopefully not quite as warm as where Peter is, but...
I'm actually in LA and it's raining, so...
We hit 70 yesterday in New York. It was like a miraculous... Yeah. I mean, I guess none of it felt like spring. It was springish.
Yeah. It might be warmer than LA today.
Today, we're down in like the high of 50 again or something like that. So, this is one day. But we will get started shortly. Okay, we're going to get started. Today we're going to be talking about Spigot NIMCRUTs. This is, if you've listened to any of our previous webinars or read our content, you may have heard about charitable remainder or Unitrusts, or CRUTs for short. A Spigot NIMCRUT is probably the most optimized version of a charitable remainder Unitrust, or CRUT, in terms of delivering you the highest amount of tax deferral, most amount of control over when you take distributions. We're not going to go too deep, but this is really how do you defer taxes on when selling appreciated assets and really drive up your returns. Before we get started, give kind of just a quick overview on Valur and ourselves. So at Valur, our goal is to help people really understand what are best practice tax mitigation strategies. What do billionaires and family offices use for their clients to reduce, whether it's their ordinary income, capital gains, or estate taxes? And at Valur, our goal is to help you understand what are those options, what are the quantitative as well as qualitative trade-offs and benefits. And then we use technology. We have tools, content like this. You can set up time with us to understand those strategies. And then we built technology to automate the setup and administration of these structures. So it's a better process, more optimized. And really the idea is so everyone can use this to build their wealth more efficiently. Peter, do you want to give a quick introduction on yourself?
Yeah, so my name's Peter. I'm the head of estate planning at Valur. My background is I'm actually a trust and estates lawyer. I joined Valur from a law firm last year.
Perfect. And so I started Valur, and this was based on a personal situation of I worked for a startup that IPO'd, and really my goal, and living in California, and the goal at the time was how do I defer capital gains? So CRUTs, NIMCRUTs, her personal really kind of helped me start this journey. And going through that, the pain of trying to figure out solutions, the cost of working with, kind of professional service made it really hard to access. And the whole idea of Valur is how do we make it more transparent as to what are these solutions and easier to access and utilize these solutions for everybody. So today we're going to talk about starting with the basics of, we know not everyone knows what charitable remainder trusts are. What are the basics of it? Then kind of understanding kind of what's the more advanced version of charitable remainder trust, which was something called a NIMCRUT. We'll explain what that stands for, what that means. And then we'll go into a specific version of a NIMCRUT. It's called the Spigot NIMCRUT. What it is, why it's more powerful, what's the additional value add. Then we'll really go through a case study to help you understand what are the financial implications of the benefits and differences between doing nothing, charitable remainder trust, NIMCRUTs, and a Spigot NIMCRUT. So, and just kind of as if you have questions, please let us know in the chat. We'll do our best to address them in real time or where it makes sense, or the worst case, we'll address them at the end. But we're typically able to address them pretty close to when you ask them. And we love to see questions. So, all right, let's start with the basics. Peter, what is a charitable remainder trust, or also known as CRTs?
Yeah.
What is it?
Yeah, so this is kind of my quick 3-minute high-level overview of what these are. So there's a type of trust called there's a category of trust called a split interest trust. which is a trust for the benefit of both an individual and a charity. There's a few different types. Basically, in each type, there's either an individual beneficiary during the term and a charitable beneficiary at the end of the term, or a charitable beneficiary during the term and a non-charitable beneficiary at the end of the term. The charitable remainder trust, the way it works is there's a individual beneficiary during the term, so probably you, and then there's a charity that gets the remainder interest at the end of the term. And so the term lasts for either a certain number of years or your lifetime, typically. And so let's say it's a 20-year term, you would get distributions personally every year for 20 years. And then at the end of the 20 years, whatever was left over, the remainder interest would go to the charity that you selected. And so the idea is a couple of benefits. One is you get an upfront charitable deduction equal to the present value of the remainder interest. It's typically set at 10%, which is the minimum that you can do. And so you get a 10% charitable deduction. And then on top of that, you're able to sell assets inside of the trust without realizing any immediate capital gains. The capital gains is actually carried out to you eventually with your distributions. And so over time, you pay the capital gains tax on the initial sale. But because you don't have to pay the tax immediately, and the trust doesn't have to pay the tax immediately, the trust is able to reinvest the entire pre-tax proceeds and generate gains on that entire pre-tax amount. So that's really the big benefit of the charitable remainder trust is that ability to defer tax and invest the full pre-tax sales proceeds and generate returns on that full amount.
Yeah, and to just really hit on because of that tax deferral, one of the most common use cases for charitable remainder trusts is selling appreciated assets, right? And this is you see kind of folks like Phil Knight, who's the founder of Nike, sell his shares within these structures. And we see people sell everything from public shares like Phil Knight to private stock to cryptocurrency to real estate to there's all sorts of kind of use cases in which you can use this. That's kind of the core. Now let's go to the kind of there's different types of charitable remainder trusts. We specifically focus on charitable remainder unit trusts, which are known as CRUTs. There's CRUTs and CRTs. We're going to just keep this focus on CRUTs because those are typically much higher returns and value for individuals. And within CRUTs, there's 3 types of CRUTs. And I know this sounds like a lot, but we're going to focus on today what's called a NIMCRUT. And Peter, do you want to give it a kind of, maybe we can explain what is a standard CRUT and what's a NIMCRUT?
Yeah. So a CRUT, so Monty briefly mentioned CRTs and CRUTs. We're not really going to talk about CRTs, but CRTs, the A in CRT stands for annuity. They pay out a fixed dollar amount every year. CRUTs pay out, the U in CRUT stands for Unitrust. They pay out typically a fixed percentage, or the distributions are based on a fixed percentage. And so if you had a 20-year term, the fixed percentage would be something like 11%, depending on some assumptions. It would be around 11%. And if you had a 15-year term, it would be a higher percentage. If you had a lifetime term and you were younger, it would be a lower percentage. So the percentage is based on the term or projected term of the trust. And so a standard CRUT simply pays out that fixed percentage. So if it's 11%, then the trust is going to pay out 11% of the trust assets every year. And so, and that's going to, the 11% is going to revalue every year as the assets in the stock gain or lose value.
Yeah.
And so
as an example of that,
yeah.
Let's say it's worth $1 million when you put it into the trust at the end of the year. Then you'd get 11% of that in the first year, so $110,000. Let's say at the end of year 2, it's worth $2 million. You'd get 11% of that $2 million, or $220,000 that year. So it's not a fixed dollar amount; it's a fixed percentage of that year's trust value.
Yeah, exactly. So the other thing about the fixed percentage is that you can never run out of assets in the trust because if the assets lost value, your distributions would shrink, and so you never run out of all of the money in the trust. There's always something there because it's always distributing a percentage that's tied to the current value of the assets. And So so a standard CRUT is simply paying out that fixed percentage every year. And so whatever it is, it's predetermined when you create the trust, and it's always going to be that percentage. So if it's 11%, it's always going to be 11% until the end of the term. A NIMCRUT is sort of it's a variation on the CRUT idea, but instead of just paying out a fixed percentage like the standard CRUT does, what it does is it pays out the lesser of that same fixed percentage or the trust accounting income of the trust. And so trust accounting income is basically it's basically what you think of as income, like cash flow. So dividends, rents, royalties, capital gains in some cases. So let's say you're investing in the stock market, like an index fund, and your dividends are 2% a year. So let's say your payout rate is 11% a year. The trust income is just going to be the dividends, assuming you don't sell stock. It's just going to be the dividends, which is 2%. The fixed percentage is 11%. 2% is less than 11%. And so you're going to be taking 2% a year rather than 11%. And so you might think, wait, if I take out 2% instead of 11%, aren't I getting less out of it? Like, don't I get less from the trust? And the answer is yes, but there's a provision in the trust, the M in NIMCRUT makeup, that allows you to catch up on lost distributions from previous years. And so if you've been taking out 2% a year for 10 years, but you're entitled to 11% a year, basically you're able to make up the difference in some future year by generating income, usually by selling appreciated assets.
And that's it's a really important point as to, if you have less income, you don't lose the right to those distributions. Because again, and you hit on this, Peter, is you're wondering, if I get less distributions, does it make me worse off? The answer is that you're not getting those distributions today. You're still entitled to those distributions when the trust has income in the future. So it's not you're losing them. It means you can get them in the future. Yeah. And, there's kind of this basic concept in finance that money today is more valuable than a dollar today is worth more than a dollar tomorrow. But in this case, it can actually create more value. And we can get into, Peter, maybe that's what you're getting to next. Yeah. But it can actually create more value of not taking those distributions today.
Yeah. Yeah. So when we began, we talked about how the big value of a charitable remainder trust, the main benefit, is the ability to defer sort of paying taxes. And the longer you can defer paying taxes, the more opportunity you have to reinvest sort of the amounts that would have been taxed but haven't been taxed because of the CRUT. You're able to reinvest those amounts and generate returns on those amounts. And so in an ideal world, you would defer taxes as long as possible and be able to reinvest all of the pre-tax sales proceeds from the sale, the initial sale of the appreciated asset. You'd be able to reinvest all of that amount for as long as possible and generate returns on that full amount. What a NIMCRUT does is it allows you to pay taxes more gradually over time. And so instead of paying taxes on whatever 11% of the proceeds are, or 11% of the value of the trust assets every year, you might be paying tax on 2% of the trust assets every year, which means the tax is going to be deferred further and further into the future. And so you might only pay, a quarter of the, let's say you had an initial $1 million asset that you sold and it would have generated $300,000 of tax liability. With a standard CRUT, you might pay that tax liability or a lot of it over the course of the first 10 or 15 years. But with a NIMCRUT, over the course of the first 10 or 15 years, you might only pay, a tiny fraction of that initial tax liability, just because the lower distributions mean that you're able to defer tax further into the future.
Yeah, and I think this is a broader point to hit on with the value of short remainder trust really comes, and you hit this up front, is deferring taxes, right? And just the simple example of, let's say you received startup equity or bought cryptocurrency or some asset that was worth almost nothing to start with, and you were selling it for $1 million. If you're in California or New York, you'll probably lose close to 35% in federal, state capital gains taxes. So In that case, you lose $350,000. The real benefit of a charitable remainder trust is instead of only having $650,000 to reinvest, these structures don't make sense if you need to spend the money. But if you're going to reinvest the money, that's really where their value comes from. With a charitable remainder trust, instead of having $650,000, you have $1 million to invest. And to just kind of play this out, let's say you're investing the assets and they're growing 10% a year to keep numbers round. That $1 million inside because a charitable remainder trust is tax exempt, when you invest that $1 million, you get to invest the full $1 million. So $1 million growing 10% will grow $100,000. Versus if you'd sold it in your taxable account, you'll have $650,000. And $650,000 growing 10% is $65,000. And so starting with a lower principal or paying the taxes up front means your growth is going to be smaller, even if you invest in the same assets. And when you compound this over 5, 10, 20, 30 years, you create a really large difference. In the first year, it's $35,000, but every single year, that difference will get larger. And to kind of tying this together to what Peter's saying with a NIMCRUT, you can defer these taxes even further. And so kind of, at the bottom of the slide, we talk about with a regular taxable account, you have no tax deferral. You sell the asset, you pay the taxes, and you have what's left after taxes to reinvest. CRUTs all allow you to defer taxes on that initial sale. Now, as Peter mentioned, with standard CRUTs, you have to distribute some amount of that of the trust money every single year. And when you take that distribution is when you pay the taxes. Because with the standard CRUT, you can't defer distributions, you're not taking it all out. So you're deferring most of the taxes, and you're able to create more value than a taxable account because you're deferring most of the taxes, but you still have to take some amount every year. With a NIMCRUT, even further, you can defer even more taxes by whether there's less income or purposely not realizing gains so that there's less distributions and less taxes paid. So you get more pre-tax growth and compounding. And then a Spigot NIMCRUT even allows you even more control to defer those taxes. And really the way to think about this is the longer you can defer your taxes and have tax deferred or tax-free growth, the more wealth you'll create. And that's really the value of charitable remainder trust in general and the magic of Spigot NIMCRUTs. Anything else kind of you want to add on NIMCRUTs, Peter?
No, I think that about covers it.
Yeah. Let's get to this. Spigot NIMCRUTs are a really unique and kind of powerful version of a NIMCRUT that takes kind of what Peter's saying to the kind of the next level. And so Peter, want to give an overview of kind of what's the value of a Spigot NIMCRUT and what does its structure look like?
Yeah, so the basic idea is that a Spigot NIMCRUT is a NIMCRUT that has a single member LLC that it invests through. And so rather than just holding assets inside the trust, without anything else, it holds assets through an LLC. And so the idea is that the LLC itself is disregarded for income tax purposes. And so everything in the LLC is treated as being owned by the NIMCRUT for income tax purposes. But for trust accounting purposes, and remember, if you go back to the previous slide, a NIMCRUT distributes the lesser of a fixed percentage or the trust accounting income. And so this confuses people. It's probably the most confusing part of this whole sort of discussion. But trust accounting income is not the same thing as taxable income. And so you could have $1 million of taxable income, but $0 of trust accounting income. They're not the same thing. Trust accounting income is an accounting concept. It's determined by some combination of the trust agreement or state law, and so it's not the same thing as taxable income. So anyways, the important thing to know is that as long as assets are retained inside of the single member LLC, the NIMCRUT won't have any trust accounting income in general. And so, NIMCRUT has to distribute the trust accounting income each year that it has. But if it has zero trust accounting income because the income is inside of a single member LLC, then it doesn't have to distribute anything. And so instead of distributing, like in the example where you have an index fund that's generating 2% dividends each year, with a normal NIMCRUT, you'd be distributing 2% a year. With a Spigot NIMCRUT, because the dividends would be inside of an LLC, there wouldn't be any distributions unless you wanted to make a distribution. So there'd be zero trust accounting income, and so there would just be no distributions. And so you could go 10 years potentially without a single distribution from the trust. And so that means that you're getting not just sort of partial deferral, but you're getting 100% deferral for the first however many years. And so you could potentially wait until, if it's a 20-year term, you could potentially wait until year 15 or something before you make any distributions.
Yeah. And so really kind of the point is, with a normal NIMCRUT, you're not, unlike a standard CRUT, you don't have to take that full percentage of distributions each year, but you have to take the realized income. And with a Spigot NIMCRUT, it doesn't matter whether you sell Apple stock or receive dividends. It's your choice to when you take distributions. So you can control when you need the money. And until then, really maximize the pre-tax growth. Is that kind of a fair assessment?
Yeah. And so in other words, it both gives you more deferral and sort of more control in general. And so, with a NIMCRUT, the advantage of a NIMCRUT versus a normal CRUT is that you have some amount of control over distributions, because you can choose what to invest in. And if you invest in a lower income producing investment, like a index fund or something, you're not going to have a lot of cash flow, and so you're not going to have a lot of distributions. But you're still sort of at the mercy of whether the stock's throwing off dividends or capital gains or whatever it is. With a Spigot NIMCRUT, you can really, really control the distributions from year to year, even if you're investing in, private credit or something that's throwing off a lot of cash flow.
Yeah, it's very hard to get the combination of control and more tax deferred growth. Typically, when you get some tax benefits, you give up control. This, relative to other CRUTs, gives you more control over distributions and more tax deferred growth, which is a really powerful combination. There's a question as to, is there a concept of a NIM charitable lead annuity trust? So for context, charitable lead, well, I'm assuming annuity trust, they're known as CLATs. They're somewhat similar. They're kind of a reverse of a charitable remainder trust, where instead of you receiving or being entitled to a distribution every year, a charity receives a distribution every year. And with a CLAT, you receive what's left at the end instead of a charity. There isn't a remainder of a NIM charitable lead annuity trust. With CLATs, you have to give the charity. There's no NIM version. There's two types of charitable lead trust. There's charitable lead annuity trust and charitable lead Unitrusts. Yeah. So, but we talked about kind of what's the value of Spigot NIMCRUTs and kind of how does this stack up. So, third, kind of the next piece is let's talk about, when do these things make sense? Like, what's the use case of when someone makes the sense to do this? I'll start with kind of the basic premise. CRUTs in general make sense to use if you're selling highly appreciated assets, right? But taking aside kind of the assets, and that could be public stock, private stock, real estate, crypto. But beyond that, Peter, when does it make sense for someone, if they're choosing which type of CRUT to use for their life or their situation when funding it with an appreciated asset, when does a Spigot NIMCRUT make sense?
Yeah. So one thing you have to think about is liquidity. So for a Spigot NIMCRUT to really optimize, you have to not make distributions for an extended period. If some people set up CRUTs and they say, I'm really just trying to convert this appreciated asset into an income stream in a tax efficient way. And so if you do a standard CRUT, you're getting, let's say, 11% a year from the CRUT. That might be, you might need that 11% of cash flow to fund your retirement or whatever it is. And so you might actually prefer that, even though it means you're not getting as much deferral as you would with a NIMCRUT or a Spigot NIMCRUT. And so the first question is, are you looking to optimize long-term returns, or are you sort of looking for some combination of tax deferral, but also some cash flow in the near to medium term? And so for the person who doesn't really care about sort of cash flow over the next 10 or 15 or 20 years, a NIMCRUT, Spigot NIMCRUT, or a NIMCRUT more generally, can make a lot of sense, because that means that you're still going to get a lot of deferral. And you're not going to get very much cash flow, but you're going to get a high ROI at the end of the term. But if you're more focused on cash flow, it's not going to make as much sense. There's Monty. We lost him. I was just talking about the first point there.
The long term. Perfect. Wanna to kind of hit on the other pieces here.
Yeah. So the second one is planning on contributing illiquid assets to a CRUT. So there's a couple things. So and this is getting a little bit in the weeds, but if you have stock, let's say you're contributing stock to a charitable maintenance trust, stock is a liquid asset, and so the value is going to be whatever the value of the stock is. You don't need to get an appraisal or anything like that. So if it's $1 million of stock, that's going to be worth $1 million. And so, on the other hand, if you're contributing $1 million in like a privately held business, an LLC or something like that, you're going to have to get that appraised. And the appraisal is pretty likely to come in below what the asset you think is actually worth. And so if we think it's worth $1 million, the appraisal might come in at $800,000, which means there's going to be a gap between the actual fair market value and what the asset is booked at. And so, say it's booked at $800,000, but it actually sells a few months later for $1 million. That means there's going to be some amount of gain that's the difference between $800,000 and $1 million. That's going to be treated as trust accounting income, but is going to be so it's going to come out of the trust. If it's a NIMCRUT, it's going to come out of the trust basically immediately. But if it's a Spigot NIMCRUT, you're going to be able to defer that differential indefinitely until you start making distributions. And so if you're thinking of doing a NIMCRUT, but you have a privately held asset that's going to generate some capital gain in the first year because of the difference between the appraised value and the fair market value, then it might make sense to do a Spigot NIMCRUT rather than a regular NIMCRUT.
Yeah. And I mean, I guess just going to this point, right? It's just, it really comes down to fundamentally is generally NIMCRUTs make sense when you're focused on long-term returns and don't need the money immediately. What are the scenarios where you think that a NIMCRUT makes more sense to just do a regular NIMCRUT versus a Spigot NIMCRUT? I think there's one scenario. There is some added cost to doing a Spigot NIMCRUT, so maybe your CRUT doesn't. There's enough assets to justify the CRUT, but maybe not the Spigot. But are there other scenarios that come to mind when you'd say, hey, the NIMCRUT's going to make more sense than the Spigot NIMCRUT?
Yeah. So there's so in terms of the Spigot NIMCRUT is going to make the most sense really if you're planning on investing in an asset that cash flows a lot, like private credit or something like that. So if you set up a NIMCRUT, let's say you've already decided to set up a NIMCRUT, you're not going to do a standard CRUT. If you set up a NIMCRUT and you invest, let's say the fixed percentage is 8% a year, and then you invest in private credit and it's paying out 8 or 9% a year, the NIMCRUT is going to behave the same way as a standard CRUT. So it's the lesser of 8% fixed percentage and 8% trust accounting income is 8%. And so the fact that it's an NIMCRUT isn't really gonna generate any additional deferral. And so if you want to generate additional deferral with an asset like that, the only way to do it really is through a Spigot NIMCRUT. So that's sort of like the prototypical use case.
Yeah.
And
I would say,
then
and I was going to say, we will get into this even in the case study, but even if you just invest in the stock market with dividends and distributions, it still is pretty meaningful as well. Like private credit, higher yielding things are even more accentuated, but um,
yeah.
the
Yeah, and then the other sort of common use case is you just have you just have a date in mind that you want to begin taking distributions on. And so let's say it's, you're going to retire in 10 years. You might say, I just don't want any distributions at all until year 10. And then after that, I'm more flexible. And so with a NIMCRUT, you can't totally control that. There's going to be some distributions over the next 10 years. With a Spigot NIMCRUT, you can totally control that situation. And so there's not going to be any distributions unless you want them to be over the next decade or however many years.
Yeah. There's a question here from this is about NIMCRUTs. Is that limited to the income? Like, so let's say you put $1 million into a checking account and it doesn't grow ever. That you would have a makeup amount, but you wouldn't be able to distribute that original principal. Really, the idea is after you sell the original asset, you're looking for growth on that asset or the proceeds of that asset. Essentially, it's when you sell, you contribute asset X and you sell asset X, you want the income in a NIMCRUT is limited to the growth above the sale value of asset X.
Yeah.
So if you're not going to, you could use typically people don't put assets into CRUTs and put it in a checking account. It could work with a standard CRUT, but the whole point of CRUTs is you defer the taxes up front and then you can reinvest what would have otherwise gone to the IRS. If you're not investing that money, you're not really making use of the CRUT, and the CRUT's not going to make sense. Yeah. So, and this is even more so true for NIMCRUTs, because in a standard CRUT, you can distribute the principal. But again, if you're not reinvesting, you're paying taxes when you take distributions from a CRUT. So if you're not reinvesting it and getting tax deferred growth, you're not really getting value from the structure and it won't make sense. But in the case you called out, because there's no growth after you sell the original asset, there isn't a distribution amount, there is a makeup amount. So if you invested that amount and then it kept growing, then you'd be able to distribute that. But we kind of mentioned this a couple of times as to kind of what's the value of, well, we'll show the value of CRUTs, NIMCRUTs, and Spigot NIMCRUTs. Let's start with kind of this basic scenario of Alice. She's a high-income Californian. She's 55, plans to retire a decade from now. She has $1 million in a highly appreciated tech stock. Really, she wants to diversify, sell this concentrated position tax efficiently. And so the idea is kind of what is the value of using a CRUT in general, a NIMCRUT and a Spigot NIMCRUT, assuming that she doesn't really want the money for a year, and she's going to invest the money in the public stock market. And I think the assumptions we're using is that it grows 8% a year, Peter.
Yeah.
So, so just kind of giving you this and the idea is that Alice, she's going to put it into the CRUT. She could not use a CRUT. She could use a CRUT and sell it. And then she wants to really minimize distributions over the next decade. And then as she retires, start taking distributions to fund her retirement. So we'll get with the basics here. Is the highlight is a Spigot NIMCRUT is going to have, after taxes, 206% more distributions after tax versus doing nothing, and 55% over a normal NIMCRUT. A normal NIMCRUT is still delivering, almost 100% higher returns than doing nothing, which is obviously great, but a Spigot NIMCRUT's even higher returns. And, we could probably give some breakdown here. Really, this is driven by two things. Doing nothing has the lowest returns because you're paying that $300, when you sell that $1 million, you're paying taxes up front. So you're losing $330,000 up front. It's kind of similar to the example I gave up front. So instead of having $1 million to invest and grow 8% a year, you have $670,000. And then the difference between investing that $330,000 and growing it over Alice's life. That's the difference between doing nothing and a NIMCRUT. And then the difference between a NIMCRUT and the Spigot NIMCRUT is because when Alice invests in the market, it's growing. We had assumed, I think, 8% a year. There's some dividends and realizations that happen every year. And so she's forced to take $290,000 of distributions over that first decade and pay taxes on that instead of having that grow pre-tax and create more wealth. And that 290,000 compounding over the rest of her life is what creates this additional value. Is there kind of anything, Peter, you think that important to call out here as to like, or why this is working, or kind of?
No, it's just what we discussed over the last few minutes. So it's basically, it's just additional deferral. And that additional deferral is yielding dividends. Pun intended.
That's the simpler. That's probably the simpler. Really, the more you can defer taxes and reinvest the money, generally, as long as you're growing your assets. To the question earlier, if you're growing your assets, you're going to create more wealth. Those are really two. If you're growing your assets, paying taxes later versus now is generally going to come up with better returns. And this is where CRUTs are better than doing nothing. NIMCRUTs are better than standard CRUTs, and Spigot NIMCRUTs are better than normal NIMCRUTs. That's kind of the key piece. And we really just want to put it in numbers as to how big what seems like small differences in terms of taking distributions or paying taxes really magnifies with compounding over time. Yeah. And that's kind of really the big things. We just want to say is, if you have questions, you can visit us at valur.com or learn.valur.com to check out content on this. You can email Peter or I directly at our first names at valur.com, or you can go to valur.com to schedule time. I also want to call out, we have tools where if you want to estimate the value of these structures yourself, we have tools like guided, we have what's called our guided planner, or calculators where you can actually estimate the returns of these structures yourself. You can choose how old you are, where you live, cost basis, expected sale value, adjust growth assumptions, and you can start to see with these, whether it's a charitable minor trust, different timelines, these different structures, what is the value of the structure and over what timeline, and how does that compare? You can see these ROIs. You can do this for different types of structures. You can also, if you more broadly want to compare, we were looking at just charitable minor trusts. If you want to compare between different types of capital gains tax deferral structures or ordinary income structures or estate planning structures, we also have tools where you can do this and compare the ROI of these different structures, kind of on an overall basis as well as annual basis. And there's also, you can always feel free to chat with us as well if you have any questions. We'll leave another minute for questions, but really appreciate everyone taking the time to join us and answer and ask us these great questions. There's last minute question asking if we can add a calculator that shows the payout rate for various terms. And I'll just pull this up again. Our calculator actually does show that. So for charitable minor trusts, I'll go back to charitable minor trusts. So if you can adjust your age here. And what you can actually see is based on the length you choose, what the payout rate is. So if you see this adjusted term, you'll see these numbers adjust as well. Long as possible, this may include someone else's life. You can see what those payout rates are here. So appreciate everyone joining us, and please let us know if there's other topics you'd want us to discuss. And hope everyone has a great rest of their week.